Hi, this is Randy Finney with Right Side of the Chart, and today is Friday, July 29th, 2016. This is a brief market update I wanted to do. I've made a few mentions of a couple of developments in the markets today in the trading room, but I wanted to put this out there for anyone that has the time to watch this video today. A couple things that stand out to me today. I've mentioned in the trading room earlier that we've had at this point, albeit it's a little early because we haven't closed yet. This is a daily chart of the S&P 500, so going on sell signals and other things such as candlestick patterns and all that, you want to wait when trading the daily time frames. At least in my book, you wait for a daily close. In other words, if you saw a bearish engulfing candlestick during the day, well, that could certainly markets could ramp into the close, and then that would no longer be a bearish engulfing candlestick if the bottom of the candlestick closed, above yesterday's prices. That's one example. The other is this the MACD. I pointed this out in the trading room. We finally have that confirmation, what I call confirmation of a divergent high. By confirmation, what I've been waiting for is to see the MACD put in a higher high. I'm sorry, a lower high versus back here. Now, forget about the intermediate divergences, the series of three. What I'm focused on right now is from this point where the MACD made that higher high, so did the RSI down here. From this point all the way back in, mid-March, all the way up to this point recently, mid-July, late July, that is one large divergence. We had two trend lines to define it, and one large divergence down here on the MACD and the RSI, and that divergence is now confirmed because the MACD has put in a lower high, and it has also made a bearish crossover. Now, the caveat that I'll throw out here, again, being a daily chart, we need to see the S&P 500 close either flattish, even right now we're about flat, but the crossover is still in effect. And to see it a little more clear, you can put up the MACD histogram, which I just did. The MACD histogram just shows it's a differential between the two MACD lines, the MACD and the signal line. So when the MACD is above the signal line, you have a green histogram, green bars, and when it crosses below, when it's flat, the reading would be 0. So any negative reading means now that the MACD line has crossed below the signal line, thereby triggering what they call a bearish crossover on the MACD. And in my book, that confirms that divergence. Nothing says that the MACD can't curl back up after a whipsaw signal, but they're pretty rare. Usually you get a crossover, and that's going to last. You can see here most of the crossovers and a couple whipsaws in between. So just something worth pointing out, something that I've been waiting for and watching for, and that is now in place. Now, the other things I want to mention that I did point out in the trading room, it stands out to me is the market internals today, particularly in the leading index. So I already had it up. Here's the QQQ, NASDAQ 100. Well, that divergence was burned through there on the Qs. Now, the Qs are a funky little bunch. What's going on lately, and I've also pointed this out the other day, I am seeing a considerable, pronounced deterioration in breadth or market internals in this well-watched and very traded index. QQQ has a ton of assets in it. It's one of the largest, most widely traded ETFs, and everybody loves the tech stocks. That's what the Qs is chock full of. Okay, what stands out to me? I've done this. I've put together a video in the past. If you aren't familiar with it, just ask. It's buried somewhere on the site, or it's on the YouTube page. It's how to read the market, how to get real-time internals on any index, any ETF. The problem with internals, most of the sources out there, they'll report the market internals on 30-minute increments or maybe a 15-minute delay. A few brokers might give you real-time internals, but it's hard to get those. So number one, it's dated if it's a 30-minute delay. And the other thing is they don't report internals on the S&P 500. They give you the internals on the NASDAQ composite, not the NASDAQ 100, and the NYSE, and then bulletin board stocks and things like that. So if you want to know what the internals are on the S&P 500, for example, you can use my strategy here. You can do it on the NASDAQ 100, which we're going to do. So here's my point. Right now, decent gain. We were just slightly positive earlier when I pointed that out, and the markets have lifted up a little. So respectable gain of 0.2% up here in the upper right hand corner. Now let's dig down. This is a listing of all the stocks in the Nasdaq 100, the components of the Qs. I'm going to move that up there. You can see, excuse me, down on the bottom, 105 stocks are in the Nasdaq 100 right now. They try to target 100, but it's never can be, but it's usually give or take a few more or a few less. So right now we have 100 stocks. So what I do is I sort these by the percent change, and we're going to sort it by the gainers. So right now we have, there's a flat stock there because it must have changed right before I did this. So we do it one more time. Okay, it's still going to show us that. So we're going to click on this one, AAL, which would just basically, it's what I'm doing here is counting how many. So right now, 28 out of 105 stocks. So a quarter, 1/4 of the stocks in the NASDAQ 100 are trading positive. That means 3/4 are trading negative. That is horrible, horrible, Brett. That is a red flag in my book. And if you take a look at the breakdown, what's holding the NASDAQ 100 up? Well, it's these mega cap. Google, I believe, overtook Apple a while ago, and I believe is number 1 or 2 as far as the world's largest company. So Google or Alphabet, see proper name now. There's both share classes. These are mega cap companies. Amazon is a mega cap. These are the top components. These are all within the top 5 or top 10 on the NASDAQ 100. Google or Alphabet, Amazon, Microsoft, certainly, Facebook, certainly, and I think Priceline's right up in there, around top 10 or so, if I'm not mistaken. Either way, so these stocks, especially Google, I can tell you right now, without a doubt, if you backed Google out or Alphabet, the NASDAQ 100 would be down. So it's painting a false picture of what's going on in the markets. Don't believe me? Not good at math? Well, all right, let's just take a look then at the NASDAQ 100 equal weighted index. These are the same stocks. They're not going to show on this watch list because TC2000 doesn't list those components. The NASDAQ 100 equal weighted index, if you give an equal weighting to Google and Apple and Microsoft and Facebook, is down almost 0.75%, 0.70. That is a drastic, a very pronounced differential between the NASDAQ and the NASDAQ 100 and the NASDAQ 100 equal weighted. Again, we were up, what was it, what did I just say, 0.3 or whatever. We had a pretty decent gain in the Qs, up about 0.25%. We're down almost 0.75% in the NASDAQ 100. Glaring red flag in my opinion. And in fact, I pointed this out just the other day in the trading room. And I've seen this before at other, market tops, and even, before corrections, even the ongoing bull market. I know for a fact, I remember this was clearly what happened in 2007, and you can look back on those numbers, and I remember seeing that, just a market being lifted by fewer and fewer stocks as the institutions pile into fewer and fewer names for safety and liquidity, with the rest of the market, the internals deteriorating, and then boom. So I wanted to point that out, and this is quite bearish for me. So now I've mentioned the divergence on the S&P 500 I was looking for, and I'm pointing out this trend of deteriorating internals, that really all is not well under the hood. So take that for what it's worth, guys. There's still I have a little time left in this video. I wanted to keep it under 10 minutes. Let's just take a look at some charts. What I'm waiting for, I should clarify. What I'm waiting for to put these as official trade ideas. I went ahead this morning and I'm adding, just before this video, adding a little more short exposure. We can't really go all in. The trend has been strong lately, so it's not by any means an all-in short moment. But here's what we're looking at on the Qs. We have this ascending price channel. There is some support right there. There's a gap around 114. That would probably trigger. Yeah, I'll tell you what. These are the levels to watch on the Qs. A move under 114, because by the time we get there, we'll also have taken out this ascending price channel, which you can see the divergence here on that ascending price channel. So we have a divergent high. These little arrows, still waiting to see my trend indicator slip bearish. This 1333 EMA pair. I like to see the The MACD on the 60-minute time frame crossed below the zero line. That will help confirm a sell signal. So there's the Qs. Now the Qs are the strongest of all, but as I already pointed out, the NDX equal weighted index is not nearly as strong. In fact, it's broken down between this wedge type pattern. The MACD is a lot closer to crossing over, so is the 1333 histogram. As far as the SPY goes, I mentioned 215.30 on the SPY. That's a level. There's an uptrend line here just above it, but err to the side of caution at 215.30, and we're almost there on the cross on the MACD down below the zero line. We had a divergent high, I should say, back here. That's why I should leave those lines there. That was where our divergence was, because now prices have not made a higher high, and we're actually just getting a sell signal, and we're whipping around there. So they're not clear sell signals yet, but that's what I'm looking for on the SPY. The SPY, by the way, also has an equal weighted index if you guys want to follow that, and you'll see the same thing. For example, it's called the SPEW on TC2000, SPEW-X, S&P 500 equal weighted index down 0.5%. Yet the S&P 500, point up, 0.2, or SPY up, 0.5%. So there you go. That's a pretty clear way to show that the internals, things aren't as good as they look. Might look like the markets are holding up here, and whatever. Take it for what it's worth. Those big cap names are, but this deterioration, things like that, usually don't end well. It's not just a little bit. It was very pronounced, as I said, with about 20% or so of the stocks in the NASDAQ 100 holding the entire index up, with about 80% of the stocks down. So, well, it's something to monitor. Maybe the day closes and all those second and third tier stocks rally, but I doubt that, because again, this is something that I've noticed over the last week or so here. So we'll wait for those sell signals and just be on alert. If you want to take some, start into scaling into shorts, if you're a little aggressive, you want to get ahead of the position, ahead of the sell signals, because there's a good chance, I think, with what this market has done, they probably would kick off the next downtrend when it comes, whether that's the end of today, whether that's on Monday, or sometime 2-3 weeks from now. When it comes, it'll probably come on a gap down, and based on where the charts are, I really think it's going to come by early next week. But again, this market, it's been not pushing higher so much. We broke these wedges, and that's where I thought we'd start getting the selling. So in one sense, I was wrong in the timing, but again, we haven't gone any higher either. And you can see what the SPY has done is just turned around and trade sideways. It's like an invisible hand is holding this market up. So there it is. Those are the facts. We don't have the sell signals yet. There's a couple. We have that potential divergence, but again, we need to see a daily close on the S&P 500. So it would probably be at best maybe next week before we have some confirmed sell signals. And if you're if you've been burned a couple times trying to short this market, then by all means just wait for those sell signals, because even if we do gap down and it's a sizable gap, let's say a 2% gap down next week, based on the charts, if we do have a 2% move, that will only firm up all those other sell signals I just mentioned, even on the 60-minute time frame. With divergence of this scope right here, just like these divergences, I'm not looking for a 2, 3, 4% pullback. I'm looking for something comparable to what we've had here and here. So you have to sometimes put yourself in that mindset where if there's a gap down on Monday and you've been waiting to position short, but waiting for the right time, sometimes you just have to bite the bullet, because you didn't have your very objective entry. You didn't nail the top. You don't hold off. Maybe if there's a decent gap down next week, what you can do is a half position, just in case the markets come in and back test. Maybe they backfill that gap, come back up. I know it can be tough to short, go into a full position, or long, likewise on a gap up. Because prices have moved so much at that point. So that's what I like to do, and especially when swing trading, tops like this and bottoms like this, scale in. versus an all or none position. You take a full position long down here. If you're just even hours early, look at that wick on there. We were long at both these bottoms. You can go back on the side, all of these bottoms, or within there, and sometimes within, right near the bottom. Sometimes a day or two early, start scaling in. But that's the key. You scale in. You start seeing where the markets are likely to turn. You start scaling out of your shorts, scaling in longs, and that way if you start buying here, you buy a little more here, then it reverses. And one thing I like to do too, if you were, let's say you were in cash today, 100% in cash, and you wanted to position short for the next pullback, you could certainly start what I call an anticipatory short today, in anticipation of a breakdown of confirmed sell signals on the 60 minutes, confirmed divergence here. But what you want to do is don't dig yourself in a hole. A lot of experienced traders will only average up on a position, meaning up on as a position becomes profitable or moves in their direction, instead of averaging down. It tends to be the retail investor, no offense, but the dumb money that will continue to average down on a losing position to reduce his or her cost basis. The only time I'll ever do that is if I had planned in ahead of time to scale in between, say, point A to point B. Even if prices, if I'm going long, even if prices drop down, let's say I go start buying a stock at, $100, I'll buy it down to $98, and no more than that. Other than that, like I said, you put a short, and at this point, it would only be prudent to add to that if and as each of those, sell signals, especially on the 60-minute charts that I talked about, are confirmed, at which point then you could have a full short position. All right, this has been Randy Finney with Right Side of the Chart, and I will post any updates later today or over the weekend if we have any interesting developments in the market.